Thanks, Prashant, and good morning, everybody. Always a great privilege to be asked by Ashu and the Crisil team to come and join the Outlook. So fantastic opportunity to talk to you all today. And I'll discuss some global themes, some Asia-Pacific issues, and finish off on a couple of risks that perhaps we should all be focused on in the next few months. So first of all, we see it as the year of the ox and the recovery. And we do think a recovery now is very firmly taking hold across the global economy. So we just go to the first slide. Well, so three things for you to think about here. I think the first one is that this is indeed a year of global recovery. It's been a little bit delayed so far in the last 1 to 2 months. I'll show you some data confirming that. But vaccines and certainly stimulus are going to provide tremendous tailwinds for activity in the US, Europe, and Asia Pacific all through the back end of 2021. That doesn't mean all the problems are solved and all the risks have gone away, but we do expect to see a pretty substantial rebound in momentum as we go through this year. I'll talk a little bit about China because what we're seeing in China is a bit of a change in the nature of growth. It's been very much investment-led. We expect it to become more consumption-led. That's going to be important for people that sell to China. So perhaps a little bit less demand for commodities, a bit more demand for consumer goods. And finally, we'll talk about global financial conditions. This really has emerged as a key risk, I think, for emerging markets in particular, just in the last 1 to 2 months. And we'll talk about what sort of risks we should be thinking about and how worried we should be at this point. So we go to the next slide. This just shows the effect of the pandemic on the way people move around, and then that has an impact on spending. So this is the famous Google mobility data. I'm sure many people have seen this now. This shows how much people are moving around outside of their homes in places like shopping malls, restaurants, movie theaters, museums. And when that line is below zero, it's showing just how far below normal people are moving around. They're just staying at home more often, whether it's because of lockdowns or because they want to avoid the risk of infection. There are 4 lines on this chart. These account for the major developed economies. That's the yellow line. That's basically the US and Europe. The brown line is emerging markets outside of Asia. The dark blue line is emerging markets in our region, including India. And the light blue line is Asia Pacific developed markets, including Japan, Korea, and Australia. Now you can see some pretty big differences across the regions here. Clearly, Asia Pacific was not hit as hard in some cases it was, but in some cases, whether you think of China, Japan, and Korea, as hard as other places. And you can see as you go to the right-hand side of that chart, that big second wave we had in the Northern Hemisphere winter in late 2020. Mobility declined from around about 20% below normal to back down to 40% below normal, including in the US and Europe. And that led to some soft data, particularly hiring data. The labor market started to stall a little bit. But just in the last few weeks, you can see as the new lockdowns have worked, as the vaccine is being rolled out, mobility is improving everywhere. People are starting to leave their homes once again. And we're going to start to see that in the data in the next 2 to 3 months, we think, quite clearly. Now, this is a bit of a race between the virus and the vaccine. And at the moment, at least in the high income economies, we think that the vaccine appears to have a bit of a head start. If anything, the vaccine rollout has been a bit quicker than we thought, and that should provide confidence for people to go out and spend. That's going to normalize the service sector, increase hiring, and boost consumption. And of course, with all this stimulus we're getting, we've just got the $1.9 trillion stimulus. It's probably going to hit the president's desk in the next few days. That adds a tremendous tailwind to growth momentum through the balance of this year. On the next slide, yeah, this is just a snapshot of the level of GDP. You're going to see some pretty crazy growth numbers in the next 1 to 2 quarters because the base was so low in 2020. Sometimes it's good to look at the level of activity relative to where we were pre-pandemic. 3 main groups. The economies that are already operating below pre-pandemic levels, China, Taiwan, Vietnam. It's mostly in Asia Pacific. Then you have a second group, which look likely to be back at pre-pandemic levels early in 2021, a bit earlier than we thought. And the great news, of course, is India is one of those economies. You can see India is probably going to be there in early 2021, but also the US as well. And then finally, we have other emerging markets and Europe. They're going to take longer to get back to the pre-pandemic level. In most cases, we think that's going to happen later this year for emerging markets, perhaps 2022 for Europe. But overall, this is a recovery story. On the next slide, these are just our growth forecasts. I'm not going to spend any time on these. For one reason, they're a little bit out of date. We're in the midst of updating our forecasts now, including the India forecast, which we're going to work with DK on, of course. DK provides us with all of the essential intelligence we need for our view on the Indian economy. But really, I think I just want to emphasize the extent to which you're going to see growth above average almost everywhere this year. And in fact, if I look at those growth numbers now, I see upside risk almost everywhere for those growth numbers for 2021. On the next slide, one note of caution though, and I think this is something to bear in mind as we go through this recovery period. While the numbers are going to look good, and perhaps they're going to be better than we thought maybe just 1 or 2 months ago, labor markets are still going to struggle. This shows rebased, seasonally adjusted employment across the major economies. And you can just see how far below we are the pre-pandemic level of employment. And of course, the labor force in most of these economies is growing. Just to give you an example, in the US, we're still 11 million jobs short of the pre-pandemic trend in employment. So the gap between where the US labor market is and where it would have been without the virus is still enormous. So we shouldn't worry too much about the stimulus causing massive runaway inflation. We need to see a lot of damage in the labor market be repaired over the next 1 to 2 years to really see that cost push inflation. That's not to say inflation can't surprise, but I think the labor market is still going to be a bit of a lagging indicator in this recovery, not only in the US, but in most economies across the world. Okay, on the next slide. Yeah, I'm not going to spend too much time on this. I think just one interesting aspect of the recovery so far is Asia Pacific and the extent to which on the left-hand side, it's leading the industrial production rebound in trade and manufacturing. But on the right-hand side, it's not really leading the consumption-driven rebound. That really has been a US and Europe story. We do expect that to change this year, particularly in China, which I'll come to right now on the next slide. Yeah, so China. What's the story here? It looks great on the headline numbers, and it is a good story. The left-hand side shows real GDP rebased just before COVID. You can see that China regained its pre-pandemic level of activity in 1 quarter and now is operating 6–7% above pre-pandemic levels. A remarkable recovery by any measure. But on the right-hand side, at the same time, during China's recovery, its current account surplus rose. Now, we can think about that in terms of its exports doing really well, fewer Chinese tourists spending overseas, but think of it in terms of saving and investment. What this means is China was saving more and investing less relative to the rest of the world during this recovery. That's pretty remarkable. What it's telling you is that even though China's recovery looks great at the GDP level, the details show a quite unbalanced recovery. It's being driven by the manufacturing sector and trade. Consumption hasn't really yet picked up significantly. We expect that to happen this year, and that means you might see a bit of a rotation in the way the recovery looks. One other point about China that's important on the next slide is policies. Policies haven't really been pushed too hard in this cycle. This shows our China Financial Conditions Index. It looks at lots of different variables. It helps us understand what policies are doing. When it's high and rising, it means you're seeing a lot of stimulus. When it's low and falling, you're seeing policies tighten. Look at the right-hand side. From about May last year, policies in China started to tighten significantly. That tightened financial conditions. That tells you that China's not throwing caution to the wind. It wants to grow in a fairly careful way through this cycle. And that's another reason why, although we do expect to see a recovery in China this year, we do think it probably will be a little bit below what markets are expecting in the headline growth number. And then finally on China, this is important for the rest of the world. On the next slide. What does that mean for commodity demand? I think that's important for a lot of our emerging markets globally. I think what it means is that commodity demand may have peaked in China, even though the recovery is going to continue. If you're seeing policies tighten on things like infrastructure investment, if you're seeing the recovery being driven more by consumption and less by investment in, say, in property, you should start to see commodity demand decline. On the left-hand side, this is a heat map. The darker the blue, the stronger the demand for Chinese imports of commodities. And you can see that there were lots of blue around the third quarter of last year, particularly things for aluminum, copper, and iron ore. That started to cool down. On the right-hand side, that's our global common factor for commodity imports. It basically takes all of China's commodity imports together and looks at what's driving them in a common way. And you can see it's peaked. We've already turned over. That doesn't mean commodity import demand from China is going to collapse, but I think it's going to cool down quite a bit. And for some of the emerging markets in our world, I think that means that we're not going to see the same type of commodity price increases that we saw over the last 6 to 9 months. And then finally, let me stop with global financial conditions. And I think one question, is it time to worry, right? I mean, we're seeing things start to move and we're all asking questions about what does this mean. Let me just show you one chart. We move on to the next one. 3 things to think about when we're thinking about a particular type of shock from the US bond market. First of all, what type of shock is it? What are the initial conditions? And by which I mean the fundamentals in countries that will be affected, things like current accounts and exchange rates. And then finally, what will policymakers do about it? One of the most important differences now compared to previous periods where bond yields rose is that this is a reflation shock, not a monetary shock. And I just want to leave one final chart with you to think about. This shows the US 10-year bond yield. But what we've done is we split it into the real yield, the yield that investors receive after they've been compensated for inflation, and then the inflation break even, which is basically the expectations of inflation within the US bond market. Now look at the taper tantrum, that's the yellow part of this chart. That's the period I'm sure everybody here remembers. Back in 2013, the Fed said they were going to tighten and bond market sold off. And we actually saw the RBI have to respond by hiking rates. Indonesia got into trouble, Brazil, South Africa, and Turkey. Look at real yields. That's the light blue line. That was a monetary shock. Real yields in the US market went up significantly. That drove the bond sell-off. That tightened real financial conditions. Inflation expectations actually fell. So no one was really doing anything to their growth forecasts at that time. Now, fast forward to 2021 and look at the difference in the reaction of the bond market now. Now the rise in the bond yield is being driven by the dark blue line, inflation expectations, and that's being driven by expectations of reflation and global recovery. People are pushing up their growth forecasts. Real yields, the light blue line, are starting to rise, something to watch, but so far are moving much more slowly and have not moved that much. So this is, in contrast to the taper tantrum of 2013, much more of a reflation trade rather than a monetary shock. And that gives us a little bit of confidence that this is not something that we should, at this point, start panicking about. Of course, much will depend on how far the bond sell-off goes. Will inflation expectations go to a point where the Fed will have to respond? Will real yields start to rise as markets price in a policy mistake by G7 central banks? That's possible, but we are not seeing it in financial markets yet. And I think that gives us a little bit of comfort that this is not, while this might be a headwind for growth in Asia Pacific and emerging markets more broadly, it's not going to be anything that derails the outlook, at least over the next 1 to 2 months. So let me just finish again on the final slide. Yeah, just to sort of emphasize, what are the 3 key things we're looking at and thinking about? Global growth. I think, if anything, we're going to be revising up our global forecasts. I think we're being surprised on the upside. It looks like the vaccine rollout is happening quicker than we thought. And that's going to provide a good external environment for India, I think, for the next 6 to 9 months. Are there risks? Of course, but those risks are getting more balanced. Second, China's recovery looks good on paper. It is a genuine recovery, but we're going to need to see the Chinese consumer spend more for it to be sustained this year. And that's behind our forecast, where we expect consumers to do more in China and investment to cool down. And that's going to have an impact on commodity imports. And then finally, global financial conditions. Yes, they are tightening at the margin, but they're tightening because people are getting more optimistic about the growth outlook. They're not yet tightening because people are worrying that the Fed is just about to tighten policy aggressively. So long as that continues, I think this is a mild headwind for growth and is not something that's going to derail the recovery as we go through at the back end of 2021. So let me leave it there. And I think I'm going to be talking to DK.
Thank you, Shaun, for that very insightful presentation. I have a set of questions for you from the audience. The first one is, how do you see the exit from extraordinary monetary policy, which the central banks across the globe have adopted?
Yeah, DK, I think we think that this is going to be the way it works out. First of all, they're going to start tapering their asset purchases. Then they'll stop their asset purchases, and only then will they think about raising rates. So that's the sequence. The Fed tried that, remember, in 2013, 2019. It didn't work out very well. First, we had the taper tantrum. Then we had the credit market seize up in 2018. So, this is going to be a difficult process. The BOJ is currently reviewing its own policy. We thought they would come up with some big changes. It looks like they backed away. The first central bank to try it might be the RBA in Australia. So I know that's a long way from India, but do watch the RBA, because I think they're going to be telling us how this could be done. But what are the lessons that we learned since the global financial crisis about this? Communication is key. If central banks get the communication wrong, it can be very dangerous. Secondly, the so-called neutral rate in the economy is often lower than central banks think, and there is a danger that they go too fast, but I think they've learned that lesson over recent years. And I think thirdly, risk premium will decompress everywhere. Risk premium are being kept low by the unconventional monetary policy. We should expect as central banks step back, the valuations across markets are going to correct. It's going to be painful, but ultimately in the long run, it's going to be healthy. But for now, we don't see this as a big issue, maybe outside a couple of central banks, until probably 2022 at the earliest.
Shaun, the second question is on the inflation outlook. I mean, the chatter on inflation is generally getting louder across the world. Is it really a worry in the Asia-Pacific region? And particularly, I think, given that the rollout of vaccine has been quite uneven in the region, can it create a supply chain disruption going ahead when the economy speed ahead and create supply-side inflation pressures?
Yeah, well, so look, my remarks are not going to talk about India, because I think India is a special case, and I know DK has very strong views on that. Let me talk about the rest of Asia Pacific. The answer is no. I think there's always a risk that inflation takes off in some big way, perhaps if oil prices keep rising and commodity prices keep rising. But overall, if you look at inflation in much of Asia Pacific, including in China, it's incredibly low and it's continuing to fall. China, in the last couple of months, actually went into deflation. So inflation is now negative in China. Why? Well, it's because even though they've managed the pandemic well across Asia Pacific, the cost has been that they've had to keep the service sector pretty much tied down with lots of social distancing. That's where all the jobs are created. Labor markets are still weak. There's no pressure on wages, and we're not seeing any inflation in the domestic economies. We don't think that's going to change very much over the next 12 months or so. So we don't think in Asia Pacific, inflation is something that we need to worry about too much.
Thank you, Shaun. I think that's all we have time for. And thank you very much for sharing your insights.